All right, thank you. Hello, everyone. My name is Sarah Housley, and welcome to Scottsdale Public Library's virtual program, Today's World of Safe Investing, presented by Scott Sandell. Scott is the president of the Phoenix chapter of the nonprofit organization Foundation for Personal Financial Education. And now, without further ado, please welcome Scott.
Thank you, Sarah.
You're welcome.
All right, I will get started. So a couple of housekeeping things. We've got enough people on this call that we want to try and keep everybody on mute. Unless you have a question about a slide that I have up right now, or obviously future slides, if it's pertinent to that slide, feel free to unmute yourself and chime in. Otherwise, there is a chat function. You can also type in questions there as well. And I will also open it up at the end for questions as we finish up the presentation as well. And typically I try to turn off the recording before the question session begins, just to keep the anonymity there as well. So as Sarah introduced, the Foundation for Personal Financial Education is a nationwide nonprofit organization that I run here in the Valley. And the whole idea of this program is to be able to do these classes without the sales and the biases we see out there and the wonderful dinner seminars and everything else. So hopefully we can go back to doing these classes in person. I've been doing them for Scottsdale for pushing, we might be going on 8 years now. And so we're typically at the Mustang Library and up in the Appaloosa Library. But we're also doing these classes all over the Valley as well. So feel free to join us anytime. We've got lots of classes and I'll put the website at the end. My background, again, been running this nonprofit for 8 years now. I have a master's degree from University of Arizona focused in finance. CFP, all my classes are finished at Pepperdine University, and then I own a local company that is a wealth management firm and a tax firm. So I do have practical working knowledge in virtually everything that we do have classes in, especially with today's class talking about safe investing. A lot of this stuff, it pertains to taxes and the taxation that you will see in your portfolio. So it's good to have both points of views from the investing standpoint and the tax standpoint as well. Legal disclaimer, everything we talk about today is not direct financial advice at all. This is for educational purposes only. I will review all the different types of safe investments out there and the reasons that people need them, because not everybody needs safe investments. Warren Buffett, for instance, he's got more money than he knows what to do with. He and his heirs will never spend all of it. So we'll talk about all of that. It's for educational purposes only. Please use what you learned in our classes to work with your CPAs, financial advisors, attorneys, so forth, whoever it is that you need to help apply it to your own situation. So agenda, we'll kind of get a well-rounded view of all the different safe investments out there. We'll set the stage with why people need safe investments. That'll help you understand when to use them and where to use them. We'll talk about the effect of interest rates in the United States going up and down and what their effects are on safe investments, because most of these are affected by interest rates, not stock market investing. So we have to pay attention to the interest rate environment versus the individual companies in the stock market. All right. So let's start with why we need safe investments. So the first thing we have to understand is that the primary investing strategy to build wealth is stock market. I mean, it has been for quite a long time, and it probably will continue to be going into the future. But we have to understand that that primary investing choice in the world is volatile. When we look at every decade, we have a couple of double-digit downturns, and they seem to be getting stronger and faster. And my explanation for that is that the turn of the century there, we digitized all of our stock markets, and that fundamentally changed things. And with computer trading, things can move faster, and they have. You look at now when 9/11 happened, that was a 3-year slide that we had 44% loss. Then 2008 happened, that was a 1-year slide, really, a little more than a 1-year slide. That was almost, well, it was over 50% from high to low. Then you had 2018, we had a quick bump in the road. And then our pandemic, how fast was that? Top to bottom, we lost 13 or 33%. And this says a month, but it was actually less than a month. So turbulence in our investing is normal. We've always had it, but with electronic trading, it really is fast and furious, and we do have to be careful about that. But we're also seeing that the recoveries are a lot faster too, and so it's confusing for a lot of people. So we have to understand that going forward, turbulence is going to be normal, and it will continue to be record breaking. We will continue to see volatility in our markets, whether it's because of terrorism, because of currencies that are baseless. This is the euro right here. Everybody's gone off the gold standards. We have what we call fiat currencies. It's just a confidence game. And when countries fail to make payments, Japan is completely insolvent. They're the first on the debt list. We've got issues with currencies out there. Global tensions are obviously an issue as well. They can cause turbulence in our markets. Some people say our debt is going to cause problems in our stock market, but when you compare us to the rest of the world, we're fairly low on a lot of the lists, and depending on how you calculate it. Debt to GDP is usually the standard, because our pure dollars in debt is a lot, but compared to our GDP, it's not necessarily as bad as most of the countries out there. And yeah, there's a lot of countries. Greece defaulted; it didn't affect our stock market. If Zimbabwe defaults, that's not going to affect our stock market. But Japan is, arguably the third or fourth largest economy in the world, and they are completely insolvent. They borrow money just to make payments on the debt that they owe. So there's a lot of issues out there. Germany, in a lot of calculations, has more debt than we have. The UK. There are a lot of large economies out there that have a lot of debt for us to deal with. But again, I still go back to the concept of computerized trading and news. On top of that, we can get a news feed and instantly act upon it. It's something that has fundamentally changed our markets, which just leads to market volatility. We will have volatile markets. It is inevitable. It is the way these markets work, especially now that they're computerized. So what does volatility mean to us is really the question. So when we look at the math behind volatility in our portfolio, we break it down to a really simple math equation that helps people understand why volatility can be bad in some circumstances and fine in others. So if you had $100,000 in an investment account, okay, just imagine you had a Schwab account, a TD Ameritrade account, and you bought a couple of mutual funds, and those mutual funds lost 50%. Okay, so you watched it crash and just fall apart. Went from 100,000, and now you only have $50,000. How much do you have if you earn the same 50% right back? That's really the crux of this. So your portfolio went down 50% and up 50%, and you only have $75,000 in your portfolio. Now, some people look at this and go, well, yeah, that's simple math. And other people look at this and go, what? That's not fair. My investment went down 50% and up 50%. Why don't I have all my money back? And that's the part that a lot of people struggle with. Not everybody sees the math problem here. Okay, when you lose 50% of $100,000, you lose $50,000. When you earn 50% on $50,000, you're only earning $25,000. So when you crash like this, you need to earn more just to get your own money back. And so the basis that we look at here, if we took no money out and we put no money in, we just let it sit there, we need to earn 100% before we have our own money back. So if you have $100,000, you lose 50% of it and only have 50,000. You have to wait till your investment goes up 100% before you have your own money back. Okay. So this affects us different in different phases of our life. If you're still working and saving and you put money into this account, in this example, what if you put $10,000 into this account? How much do you need to earn just to get back your own money, which means 110,000? Because you put 100 in, you lost half of it, you only have 50. You put 10 in, now you have $60,000, but you have to earn enough to get back to 110 because you put 110 in. So that's how we compare apples to apples here. You're going from 60,000 to 110,000, and that means you have to earn 83%. Now, I don't expect anybody to actually be able to do that math in their head, but what we do need to understand is by putting money into this account, did you help yourself or hurt yourself? You helped yourself. You only have to earn 83% to get your own money back versus 100% by doing nothing. Okay. So in your savings years, you were told quite often when the markets fluctuated, hey, markets crashed, it's a buying opportunity, keep putting money in. The 401ks came in and they were very popular, and they're fantastic because they just keep taking money out of your paycheck and keep investing in the market. And they called that dollar cost averaging, all these fancy investing terms. Well, mathematically, it's true. When the markets crash, if you keep putting in, you're helping yourself recover. So mathematically, all these advisors that told you, don't worry about the turbulence, keep saving. Mathematically, they were absolutely right. You help yourself recover by putting money in. The problem is what if you're in your retirement years? Okay. What if you took 10,000 out of this account? And this is where the advisors in the industry tend to fail. They do a good job of it, the younger people that listen and tell them all these encouraging things to keep investing and keep saving. But when you go to retirement and you start taking money out of your account, I just don't seem to hear a lot of the advisors out there talking about that. And this is the problem. So if you took 10,000 out of this account, so remember you had 100, you lost half of it, now you only have 50, but you took 10 out. Now you only have $40,000 in the account. You have to earn enough to get 90, okay? Because we took 10 out, we got that back. So now we have to go from $40,000 just to $90,000. In order to get our own money back, we now have to earn 125%. So now the concept we have to learn here is when we start taking money out of our portfolio, we are digging ourselves in deeper a hole. So now instead of having to earn 83% when we were putting money in to doing nothing and we had to earn 100%, now because we took money out just to get our own money back, not the 10,000 we took back, to get our own money back, get back to $90,000, we still have to earn 125%. We dug ourselves into a deeper hole, making it harder for us to recover. And the question is are you going to earn that 125% back before you take money out again? And if you're in retirement, most likely not. So this is where we have to be careful in retirement. When we change our lives and start taking money out, the math changes and we have to be careful. So if you're in a position in life where you don't have to worry about taking money out, you don't need safe investments. You don't need them. If they make you feel good, make you feel more safe, I'm fine with that. But the reality is the safe investments, stable investing strategies are primarily for people that need to take money out. And that's why through your life, any financial advisor, anybody investing your money, the closer you get to retirement, the more bonds they were putting in your portfolio, the more safe investments they were putting in your portfolio. And so that's that progression that they have. They may not be able to explain why, but the reality is this is the math that explains why you want safe investments in your portfolio. You want a more stable portfolio when you start withdrawing from your portfolio. Okay. So I illustrate this in a few different ways because the order of returns, believe it or not, can matter sometimes. So this is the preservation years. This is when you're not putting money in, you're not taking money out. Okay, this money, you put it into an account, it's $100,000. You put it into account, you're going to invest it for 20 years. Investment A is the S&P 500 from 1990 to 2010. Investment B is the same S&P 500, just backwards, from 2010 back to 1990. So it's the same returns. You got the 12.7 here, you got 12.7 here, you got the -4, -4. It's the same returns, just the opposite order. And then the third choice, choice C, the blue choice, is just earning the average of these, which is 6.25. These both average 6.25%. So if you have $100,000 today, and you had a choice of investment A, B, or C, you know exactly what you're going to earn for the next 20 years. The question is, which one would you choose and which one's going to win? Here's a hint. The red one is right there. So you went from that 100,000 and then we skyrocketed. We had all these wonderful returns and then we floundered because 9/11 hit. Then we grew back and then 2008 hit. And then we're growing back again. Well, here's the green choice. We took a different path, but it's the same place. And notice the average properly represents these two choices. The results are all the same. It doesn't matter what order the returns come in. If you just put money in and let it sit there and grow, all three of these are the exact same investment. When you look at a mutual fund and it says it averages 6.25%, it could be this one and it could be this one. It could be any of this because the reality is an average mathematically represents what this investment earned over time. Okay. Now there's a reason I'm doing this because what if I do the exact same thing, but now I start taking money out? All your life, you were relying on the averages. The mutual fund said a 10-year running average was 6.25%. And you think, well, I should earn 6.25%. That should make sense. But again, 6.25% is the same as this, is the same as this. But I'm going to put $100,000 into each of these investments. And I'm going to take 6,000 out every year. I should end up with the same results if these are the same returns. This is where people start going cross-eyed. The rule of math that you have to know is that when you go to start taking money out, all the math changes. Think about that. Earning 20,000 or 20% on $50,000 is less dollars than earning 20% on $100,000. And I'm taking 6,000 out. Well, that's a 6% withdrawal rate from the initial deposit. So now volatility early, we hit a big bump in the road right here and we can't recover because we lost a big chunk of money. And now our withdrawal rate, instead of being 6%, is more like 10%. Well, if you're withdrawing 10% of your portfolio and you're not earning 10%, it's going to continue to fall apart and erode. Whereas the volatility later, it gave us an opportunity to build a huge portfolio. The 100 went all the way up to 250. Now withdrawing 6,000 a year from 250,000 is a small percentage. That's sustainable in any market. Even when 2008 hit, we never went below that $100,000. Then it went back up and it went down and went up. The reality is that when you start taking money out, 6.25 is not the same as 6.25 is not the same as 6.25. And I know that's confusing, but the reality is turbulence, the order of returns matters more now. So when a mutual fund says, I average 6.25, when you start taking money out, it means nothing. It doesn't tell you anything about that investment, and you have to ignore it. Something that says it averages 10% is not necessarily better than something that averages 3%. Case in point, here we go. Here's a mutual fund that averages 7.84%, and here's a fixed rate of return of 3%. Which is better? Well, I'm putting 100,000 in and I'm not taking money out. I would rather earn 7% than 3%. That's obvious. It's not confusing. It's obvious. If I'm going to invest my money, I'm just putting money in, 7% is always better than 3%. But what happens when I use the exact same investments and I go to take money out? 7% got blown away by 3%. I'm running out of money with my 7% mutual fund versus a 3% fixed rate. And so when you're retired and you're starting to take money out, I'm not telling you to go throw all your money in a fixed rate. I'm telling you that safe, stable investing strategies perform more reliably and better in most cases than a volatile portfolio. This is a volatile 7%. This is a flat, stable 3%. And that's a big difference. At 6,000 a year, this green line is going to last a heck of a lot longer than you taking 6,000 out of that, because you're out in the next year. No matter how much that stock market returns, you're not going to keep up at that point. It's over. Okay. So we have to be careful about this. It's really, really hard for people to transition into retirement unless you really understand the math that you're dealing with. So as you approach retirement, whatever parts of your portfolio, some people only pull from their IRA. Some people hit required minimum distributions and they have to pull from there every year. Well, that's where you want your safe investments. You need to be pulling from a safe, stable in portfolio. It will produce more dollars in your pocket. And that's really what matters. Okay. So we have to pull back volatility. This gray line was 100% stocks. It shows the volatility of a portfolio over the last 23 years. The highs and lows and the highs and lows, okay? Then we start adding in bonds, because historically bonds have been our investment of choice for safe, stable investing. So 25% bonds, 75% stocks. Here's 50-50, half your money in stocks, half your money in bonds. Notice your highs aren't as high, but your lows aren't as low. It's a more safe, stable investing environment to withdraw from. Here's 75% bonds, 25% stocks. Again, that's what you're looking for. You want to eliminate the highs and lows and just make it a more stable portfolio. And then 100% bonds. At some point, it's a diminishing return. So the rule of thumb the industry has, all the big boys, the Schwabs, Fidelities, Vanguards, all these guys came up with ironclad proof of investing strategies that work, that they could defend in court. Okay, so they hired a bunch of statisticians and said, I want proof that I can defend in court. So when people sue us for not investing their money properly, we can just lay it out and say, here's all the proof, the time-tested proof that says this is the best way to handle things. So the statisticians came up with this chart. There's 3 different statisticians that are out there that defend this in court, primarily used. And so these 3 different statisticians basically came up with the average person. Okay, it's not you. It's not you either. It's not you. It's not you. We have to understand that this is just the average person. This is the average 15 to 19-year-old, the average 50 to 54-year-old, the average 70 to 74-year-old. And the one thing I want you to notice is that once you reach retirement, this is your allocation to stocks. If you look at the aggressive model, the red model, the aggressive model means the most amount to stocks. All the way till you're hitting your 40s, you should have 100% of your money in stocks. And then you start tailing back because you're getting closer and closer to retirement. You're adding more and more safe investments into your portfolio. And here you are hitting retirement right around 60 here, and you have about half your money in safe investments and the other half in stock investments. And then you hit required minimum distribution phase of your life. And there you are with 40% of your money in stocks, 60% of your money in safe investments. And notice that all of these statisticians agree in the phase of life where they're confident you're pulling money out of your portfolio, they want you to be in a 60% safe, 40% stock portfolio. 60-40 is the rule of thumb for accounts that you need to pull money from. Okay. And that's proven by every statistician for all the big boys out there that have to defend themselves in court. It's not that necessarily every 70-year-old should have this. Trust me, Warren Buffett has no reason to look at this chart. And when I say Warren Buffett, I know people in retirement that, as far as I'm concerned, are Warren Buffett. If you have more income monthly than you spend monthly, meaning your pension and Social Security, you're not relying on your portfolio. You're just spending the money that comes in every month, and your portfolio is sitting there for an emergency, or it's going to get passed to your heirs. You don't have to have the money of Warren Buffett. You have to have the life situation of Warren Buffett, living off the income, and the savings is more than you're going to spend. This chart doesn't apply to you. You're not the average person. So you have to understand that when we look at this, a good financial advisor, and typically this is where the big box shops are all going to live on these charts, whereas a fiduciary has to treat everybody individually. You can use this chart, but know that this is the average person, and assess how different the client is than the average person and change from this chart. But anywhere within 10% of here, every single big box shop has to follow this because their employer defends them in court based on this stuff. Okay. So that should kind of help you understand who needs safe investments. The next part is understanding that all safe investments are interest rate sensitive. Whether it's bonds or stock, or not stocks, but bonds or CDs at banks or any of the other stuff that we're going to go through today, they're all interest rate sensitive. We do need to be careful about this. Okay. So this is the United States interest rates. It was about the early 80s. We hit the peak up here. And ever since then, we've been coming straight down. Okay. So that's 40 years now. 40 years. Interest rates in the United States have steadily been coming down and down and down and down. And strangely enough, this year we broke another record. Our 10-year interest rate went from 2% to just about 0.5%. That's a 75% loss of interest rates in a couple of days when the pandemic hit. Our 10-year interest rate in the United States went from 2% to 0.5%. That's astronomical drop. That's completely different than this. None of these were that big of a drop percentage-wise. Okay, so we have to understand interest rates are historically low in the United States. And what happens when we lower interest rates? Well, obviously borrowing money gets cheaper. The mortgage industry is going nuts. People are refinancing and buying and refinancing and buying and buying and refinancing because it's so cheap. Interest rates on 30-year mortgages are in the 2s and 3s. It's crazy. Mortgages in the United States have never seen lows like this. Okay. So that produces rising asset prices. Well, think about housing in the United States. Through the pandemic, everybody kind of thought at the beginning of the pandemic, the real estate market was going to fall apart. And we're going to see crashing of houses like 2008 again. But look what's happened to them. They're just getting worth more and more and more. Every time I look at Zillow, it tells me my house is worth 10 grand more than the previous day. It's crazy. So the values of houses across the United States, yes, it's market to market, but as a whole, value of houses in the United States have been going up and up and up through this pandemic. And whether it's a bubble or not, that's something to argue. But the reality is when we lower interest rates like we just did, it's cheaper to buy houses. It's easier to buy a $500,000 house with a 3% 30-year fixed mortgage than it is with an 8% 30-year fixed mortgage. So rising rates do the opposite. They lower the value of a house. So we have to be careful. Obviously, we can't earn interest in the banks. There's no bank account really paying much interest. You might find maybe close to 1% in a money market account we'll talk about. But other than that, I mean, I don't remember the last time I got paid interest in a checking account. I know it used to do that, but it's probably never will again. Here's the big problem with safe investing right here. Lowering interest rates, like we just did, the value of bonds increase. There is a direct correlation. So the value of your bonds hit an all-time high when that crash of interest rates this year. Bond values have never been higher, okay? Decrease in currency value, but it's relative to foreign currencies. So if everybody else's interest rates are going down, then it's an even playing field. If we're going down in interest rates and they're not, then our currency loses value. And that's where a lot of the international world interest rates are lower than ours. And so we've had a very high value of our currency. So what happens if we go back to rising interest rates? We have to climb that interest rate chart again at some point, or we're going to flounder around it near zero forever. I don't know. But rising interest rates are going to cause a lot of problems, okay? Borrowing gets more expensive, so we see people decreasing their debt, people and companies, which theoretically is a good thing, okay? Lowering asset prices though, again, I go back to that, all things being equal, if today a 30-year mortgage is 3% and tomorrow it's 8%, the value of your house will crash if interest rates just jump to 8%. Arbitrarily, that could happen, but not realistically, because you're going to see every house in the United States fall apart. So all big assets are going to fall apart if that happens, which means we have to have inflation in order to raise interest rates to counteract that. That's the only economic way we can raise interest rates meaningfully, is with inflation. Savers then earn more interest. So that helps us combat the inflation, because now we can start earning interest in the bank accounts and the CDs and things like that. And then the bond values decrease. Wait a second, what? This is scary. And this is the big problem we have in the investing world right here. If interest rates start rising, we have to have inflation if it's going to be meaningful. So when you're seeing inflation and interest rates rising, your safe investments are falling apart. This is what scares me about the general investing world using bonds. We have for the last 40 years. I have no problem with them. They've been wonderful investments for the last 30 years for safe, stable investments. But the reality is that's only because the United States interest rates have been going down and down and down. If interest rates go up and up and up, then the value of your bonds goes down and down and down. And you're going to be losing money in your safe investments. And this is where I have a big problem with the bond world right now. Buying bonds right now just doesn't seem to make a huge amount of sense. First of all, you're not getting paid very much because interest rates are very low. But second of all, if interest rates rise at all, you're going to lose value from there. So looking at these as the safe investment that we've been utilizing for the last 40 years doesn't make sense. We have to be careful about that. And then the increasing of currency value based on compared to foreign currencies. This is another big issue. Globally, they don't want us to raise interest rates until they're ready. And that's the tricky part about this. We all have to rise together. And that's the hard part. Okay. So let's talk about all these different options. In terms of bonds, the basics of a bond and understanding what a bond is. The coupon is the interest that the bond pays you, okay? So a bond is really just lending somebody your money, whether it's a corporate entity or a municipality. You can lend money to them by buying a bond. You buy the bond, they pay you interest. At the end of the maturity term, they pay you back. It's the same thing as a CD. Think about that. You go to a bank, you hand them money, they get to go invest it however they want. They pay you interest. When it matures, they hand you your money back. The only difference in the bond world is two things. The maturities are usually more like 30 years instead of the 1 year that you find in the CDs. And there's a market to sell them between now and 30 years. So you can buy used bonds, buy and sell used bonds. So a bond fundamentally is really just a CD. It's just a marketable security that you're able to buy and sell within the 30-year term, okay? And you can also buy mutual funds filled with bonds, which is just a portfolio filled with bonds that you own a share of, okay? So par value is the value they give back at maturity. If you're buying a bond, you might pay more than the par value or less than the par value, okay? Taxes, you owe taxes. If this is not a municipal bond, you will be taxed on the interest as ordinary income. This is full taxation on the interest you earn, just like CDs. Whoops. So if you go to sell a bond, if you own a bond, bought the 4% coupon, you paid par value, and you go to sell it and interest rates are 6%. Does anybody out there want to buy your 4% bond if interest rates right now are 6%? No. So now you have to discount your price. Think about that. Nobody wants your 4%. I can go buy another bond and it's going to pay me 6%. So now I got to discount my price. This is why the value of your bond goes down as interest rates go up, because nobody wants your bond. Okay. So you have to discount your price. And now you find yourself selling it for a $5,000 loss just to get rid of it. Okay. If interest rates are the same, if there were no fees, theoretically, you should be able to sell it for the same value. If interest rates go flat, then you're going to buy a bond and sell a bond for the same price. Now, here's why the last 40 years have been great. You get paid that 4% all along the way. And then when you choose to sell it, you get paid more for it than you paid for it. That's because interest rates have been going down for the last 40 years. Okay. If you bought a bond when interest rates were 4% and you go to sell them and now interest rates are 2%, everybody wants your 4% bond. Everybody wants it. So now you can raise the price. And that's what really has been the magic of the bond world, is not only are you getting paid interest along the way, but you have growth of value. And so the bond mutual fund prices inch up, and you're making money that way, but then you're also receiving the interest from it. And that's what we liked about bonds. They were great, safe investments. But this is much less likely to happen in the future, and that's what we have to be scared of. Taxes. If you go to sell, this is a loss. You can write it off. This is a gain. You have to pay taxes on it. Okay. Maturity, again, they will pay the full par value upon maturity, but there are some risks. I'm going to bounce down to the call feature. What if you were the buying side of this? You saw somebody selling a 4% bond and interest rates are where they are today, and you want that 4% bond. So you buy it for 30 grand. 2 days later, IBM or whoever it is calls it due and hands you back the par value, which is maturity value. So you get 25,000 back, but you just paid 30. These bonds, most of them have call features. There are dates in the future where they are callable. Now think about this. If I'm IBM and I'm paying 4% and I have a call date coming up and I can go issue a new bond at 2% and pay off my 4%, they are refinancing. That's what they're doing. So of course I'm going to take the call feature and hand your money back and refinance to a lower interest rate. So if you're going to buy bonds, you have to know when those call dates are, because you don't want to pay $30,000 for a $25,000 bond and have it called a few days later. Okay, that's a risk. Default's also a risk. Okay, now it's a manageable risk, but the reality is that if you buy a $25,000 bond and that company can't pay back the money and goes bankrupt, you ain't getting much back. They have to go through the bankruptcy, the lawyers have to get paid, and then they pay back any immediate debt, and then they go to the bondholders. Okay, and you guys get to split up whatever's left, which 20-30% is a best you're going to see typically. Okay, so there is risk in bonds, and the big real risk is interest rates rising. That's an erosion of the value of your investment. Okay, that's real and happens all the time. You know, your advisor that's buying the bonds for you certainly should understand the call risk and should be able to manage that. The default risk, well, that's where we start talking about ratings of companies and whether they're going to be able to pay it back. But before we do that, the only difference between a corporate bond and a municipal bond is the taxation. So if you hear the word municipal bond, it does not mean that they're safer. Okay, there are two types of municipal bonds: general obligation bonds and revenue bonds. General obligation bonds are typically the safest type of bond. They are backed by the taxation of the state or local government, meaning the city or state or municipality would have to go bankrupt, like Detroit. I'm trying to remember which one of the counties in California went bankrupt. It's certainly possible. You look at Illinois numbers and you say it's going to happen any day now. You look at California numbers and yeah, there's a lot of places that are going to go bankrupt very quickly. So yes, there is some risk in this, but those are the lower risk because that's where the federal government will bail them out. It's just the reality of it. Whereas the revenue bonds, this is the scary part of this. Okay, there is plenty of fraud in the revenue bond world. Plenty of fraud. I'll use something local here as an example. We had a shopping mall, outdoor shopping mall go up in North Phoenix, right next to Desert Ridge called, I think I don't remember the original name of it, but now it's High Street. But it's this little outdoor shopping living area right next to Desert Ridge off the 101 and the 51, right up there. When that first broke ground, it was pre-2008, and the developer happened to know some of the right people in the right positions and got municipal bond status. The municipality said, we want the growth in this part of town. We want to have this project go through. So we're going to give you special status. And these are revenue bonds because the revenues from the project are supposed to pay back these bonds. So build this big shopping center and apartments and condos and pay back the bonds through the revenues. Well, 2008 hit and they went bankrupt. And they ended up selling in the bankruptcy courts for pennies on the dollar. And last I heard, I think it was about 20% of your bonds purchase price got back, returned to you, 20%. The second developer tried to get it up and going. He bought it from the bankruptcy courts with municipal bonds. The next developer had the same people in their pocket and wanted to rescue the project. So now a second round of municipal bonds were used to buy it from the bankruptcy courts, fix it up and get it going, and they went bankrupt. And those bondholders got lost a bunch of money as well. And now the third finally got it up and running, and who knows how it's going to make it through this. So the reality is understand, bonds are bonds. You are lending somebody money. Just because it says municipal doesn't make it special. It makes it special only because it's tax exempt at a federal level. And if you're buying in the state that you are taxed, then they could be double tax exempt. But understand, Arizona taxation is 2-3% for most of you. So double tax exempt sounds really good, but you're saving yourself 2-3% in taxation. Whereas tax exempt federally, you're looking at anywhere from 10 to into the 20% range that you're saving in taxes. Okay, so that's the only difference in municipal bonds. So the ratings that we talked about, okay, when you worry about whether this is a safe bond or not, when we talk about safe bonds, we typically talk about AA and AAA. Those are reasonably low risk. Okay. Then you get into the A range, and they're okay, high to medium quality. But then you get BBB, and this is where you're teetering on what we call junk bonds. The largest buildup of bond ratings in the United States, I believe last I checked, it was over 30% of all bonds are rated in the BBB range, teetering into junk bonds. And this is really important to understand. If they get downgraded from BBB to BB, there's a whole world of investors that are not allowed to invest, okay? Meaning pension funds, banks, insurance companies. By charter, there's just so many, charter and regulation, there's so many big block entities out there that are not allowed to invest in junk bonds. Okay, these are remarketed to you in mutual funds, and they call them high yield funds. If you own a high yield fund, you typically will own a portfolio of junk bonds. And the reason these are called junk bonds is because they're less likely to be able to pay back all the money. Okay. And I just noticed somebody put in the chat, so if rates go down, the bond values increase and vice versa. The answer is absolutely yes. If interest rates go down, the value of your bond increases. Think of it as a teeter-totter. Interest rates down, values increase. Interest rates up, values decrease in the bond world. The only other thing that will change the value of a bond is this: the rating of the company that you are lending your money to. If IBM goes from AA to single A, because maybe their books aren't looking good and financially they're a little less stable this year, then the value of the bond goes down because the risk is increasing. And that is the reason we have this cutoff into the junk bond world. Junk bonds go to mutual funds to die because primarily the only large investor of junk bonds is mutual funds. And if you own mutual funds and they have bonds in them, you better look closely, because I'm willing to bet you've got a lot of junk bonds in there. Okay. These are companies that are not financially stable, that are likely to not pay back all the money. Okay. So be careful about bond investing when it comes to the ratings of these companies. Moody's and Standard & Poor's are the standard out there. You don't hang your hat on them as absolute certainty, but the reality is this gives us a general idea of the safety of a bond. Okay, because they go through each company, look at their financials, and rate them on financial stability. And that's what these are. All right. So the scary part about bonds that we see out there right now, even though the maturity, and this is a bond portfolio that came into my office, somebody showed it to me, said, I wanted a safe portfolio. This is what my advisor gave me. I looked at all the companies, they're all safe companies, didn't have a problem with that. The maturity value, okay, the par value was $25,000 on each of these. So the portfolio had $555,000 worth of par value. Okay, meaning when it matures, they're getting 25 grand back on each of these. But here's the problem. This is what they paid for each of these. See, this one paid a little less for this one, a little more. Oh, a lot more. At maturity, they're getting back 25, but they paid 28. These are the maturity dates. So this person paid $593,000 for the portfolio. At maturity, once all of these mature, they're going to get back $555,000. The coupons, the amount of interest they were receiving was 4.5%, but it was 3 here, it was 2 there, it was 6 there, so forth and so on. It averaged 4.5%. So they thought they were doing pretty good, a fairly safe portfolio, averaging 4.5%. But when I looked at her and I said, wait a second, what's going to happen to that $40,000? When these mature, you're only going to have $555,000. You paid $593,000. She looked at me and went a little cross-eyed and said, what? And that's the part we have to be careful of. If we're buying individual bonds, what you pay for it matters. So the coupon doesn't matter as much, believe it or not. You have to have the advisor or jump online and Google yield to maturity calculator. And you're going to plug in the information, what the par value is, what you paid for it, what the coupon is, what the maturity date is, and it will calculate your actual profitability if you hold it to maturity. So yield to maturity is the actual profitability of this investment should you hold it to the maturity date, which was the goal in this case. And when you calculate the yield to maturity, the actual profitability of this portfolio was only 1.92, and the advisor had a 1% management fee. This is the problem in our bond world right now. The yield to maturities are so low, and this is before the crash in interest rates. There was actually one that had a guaranteed 3% loss. First time I'd seen that. But you're not going to sue the advisor over a couple $100. Theoretically, that advisor should lose his license. He did something illegal, but good luck going to court over that. I mean, it's just not going to happen. So the reality is that we have to understand, just looking at face value, this looked like a great portfolio, but then when you actually understand how a bond works and realize you're going to lose 40 grand by waiting till maturity, you're really only making 1.92 minus the management fee. Got to be careful about these. The idea of a bond portfolio being a safe portfolio, you have to factor in fees, you have to factor in the taxation and all that stuff, because we're not making much in these portfolios anymore. When you look at interest rates right now, and again, this is just a month or so ago, so yes, after the crash of interest rates, you can see that the safe bonds out there are paying a whole lot of nothing. Got a little anomaly up here with AAA. AA, there are just so few AA's out there. I don't think there were any 20-year pluses in recent sales. But the reality is we have extremely low interest rates, and these are the yield to maturities that you're seeing in the open market right now. Okay, if somebody told you you had to buy a 20-year CD and you were only going to make 3.5%, that's you got to hold it for 20 years. Because if you try to sell it before then you better hope interest rates are lower, and that's just probably not going to happen. And you can start seeing the risk in the BBB world. Look how much better the return is here. Okay, nobody's liking the long-term. Long-term interest rates crashed. You look at these intermediate terms in here from say 5 to 10 years, and you got a nice little window of interest rate return right here, but how much risk are you willing to take? And if interest rates rise, is this return good? Okay, because if interest rates rise and you lose 5% on the value, well, you lost this year's return. This is the problem. There is risk. There is fluctuation of value in the bond world. You look at municipals, you're not making much in those either. Okay. And again, this is tax free. So you're generally going to make less, but really 2% less, more than 2% less doesn't make sense. Okay. So a lot of people flock to bond funds, but I'm going to flat out tell you it's a terrible idea to be in bond funds. Okay. Interest rates up, the price of your bond fund goes down. It's much more efficient. Okay. Because the price of a bond mutual fund is represented by the value of its portfolio. Whereas if you own an individual bond, the value of that bond is only important when you go to sell it. Okay. It's like a CD. If you just wait till maturity, you're getting all your money back. You don't have to pay a penalty. Okay. Whereas a bond mutual fund, you don't need the money, but interest rates go up and the value of that portfolio goes down. And then it goes down, and then it goes down. So a bond mutual fund doesn't have a maturity date. There is no way for you to just wait and get all your money back. Okay. So we have to be careful about these bond mutual funds if interest rates start rising. They're great when interest rates are going down because efficiently you're getting the rise in value. We love bond mutual funds when interest rates are going down. We hate them when they're going up. Got to stay away from bond mutual funds when interest rates are rising. Okay. So jumping through some physical assets, and I spend a lot of time in bonds just because they have been the safe investment of choice for so long now. Okay. But some people can use physical assets as safe investments. And this is where real estate and precious metals really come in. Now, look, I am not going to sit here and tell you that owning physical gold is an investment strategy. Just not. There are fancy ways you can do it. There's companies that'll lease it from you, meaning you can own physical gold and give it to somebody to hold on to it. And they write an IOU for this much gold. So they have to return the same amount of gold to you. Okay. And then they pay you interest to hold on to it. It's really fascinating. But is there risk? Yes, there's risk. So now you can get an interest on your gold. Well, that's a neat concept. But the reality is this is for people that want to store wealth for a long period in the future. Meaning, maybe you know you have more than you're ever going to spend, and you want to protect from financial and currency Armageddon. That's insurance. Great. I don't have a problem with you owning some gold. Let's say you have some grandkids and you want to kind of build a bag of gold coins for your grandkids so that maybe 30 years from now they're going to inherit. Great. Wonderful idea. I love precious metals for stuff like that. But don't go buying the physical metals as a speculative investment that you think the price of gold is going to double in the next 10 years. It's expensive to buy and sell. There's a cost in buying and selling. It's kind of like changing your currency to euros and then changing it back. You can do it in the same minute and you'll end up with less money. Okay. Precious metals, owning the physical stuff, unless you get fancy, they don't pay interest, they don't pay dividends. You have to be careful with this stuff. This is really just storing purchasing power for long periods of time in the future. Don't put IRA money in gold. You can't tear off a chunk of this and do your RMD, okay? Don't fall into any of that stuff. You can buy the paper gold, the GLD index. There's publicly traded indexes that follow gold. If you really want to have it in your portfolio, you can do things like that. This is for money you just have kind of storing away in coffee cans, all right? Or because you have the amount of money to protect yourself from the currency crises or major meltdowns, which I think a lot of people can sit back logically and say, in the next 30 years, it's certainly possible. And if you have more money than you're going to spend on yourselves, protecting yourself from something like that, why not? You got plenty of money to do it. So I don't have a problem with that type of mentality when it comes to precious metals. And then there's real estate. Lots of different things in real estate. Look, we can talk about building wealth in real estate when we talk about, mortgaging it and paying the mortgage down over years and building wealth over a long period of time. Fantastic. Get started young, build wealth in real estate is a fantastic strategy. I don't have a problem with that. But when we talk about safe investment choices as a retiree, if you have more money than you can spend and you're contemplating owning a second home, I'm a big fan of it. Real estate is a fantastic inflation hedge. If we see big inflation in the future, if interest rates stay low and we see inflation, you own a great asset. I love real estate for that reason. If you have no problems managing rentals can be great, especially this whole short-term rental world. You get a great return on your investment. It takes work though. This is a different type of investment that it has different types of risks. Dealing with renters, dealing with damages to the house and things like that. It can be a great investment, but it takes management of the investment. So you do have to be more careful, because the more people you put between yourself and that house, the less profitable it is. Okay. I'm going to rush through these because I'll be honest, I'll show you the interest rates at the end and you'll realize they're just useless right now. You may own some double E bonds or E bonds or I bonds. If you bought them 20 years ago, fantastic, hold on to them. You're probably still getting paid 3-4%. I saw 6% the other day. But going and actually buying government securities right now is unexplainable. I don't know who pays for these things. I don't know why. I don't know how. It doesn't make any sense, other than I know that governments, other countries buy our treasuries. And they use it to stabilize their own currencies. That's the only reason I know of. Because to be real honest, if I had met somebody that actually went and bought this stuff right now, I would not have an explanation for why. So at treasurydirect.gov, you can invest in our US treasuries. You can buy T-bills and T-notes. They come in $100 minimums. The bills are in weeks, okay? The maturities are within weeks. The notes are within years, 2 to 10 years, 4 to 52 weeks, okay? Sold at a discount in terms of bills, meaning you would pay $90 and get back $100 at maturity. So whatever the interest rate they would pay you, and right now it would be, you would pay $99.87 and get back $100 a year later. That's how low the interest rates are, by the way. And then treasury notes, it's a fixed interest paid to you every 6 months. But it is simple interest. They only pay you interest on your original investment. Tips, treasury inflation protected securities, minimum $100 purchase. They're sold in terms of 5, 10, and 30-year terms, okay? Principal value adjusts based on the CPI, plus they pay you a fixed interest rate every 6 months. You can hold them till maturity, or there is a second market. There's an auction they hold to sell your tips. But you got to find somebody to buy it from you, just so you know. It's not easy. Interest rates, it's all taxed federally, but for some reason the state doesn't tax you. It's the Fed's paying you the interest, but then they're going to take it back in taxes. Oh, and the Feds who pay you the interest are also the ones who calculate the consumer price index. Yeah. All right, so floating rate notes, this one's a 2-year term. It pays interest based on the 13-week auctions. So you have an investment that you have to hang on to for 2 years, but they're only paying you a 13-week interest rate. This is one that doesn't make a huge amount of sense either, but they exist. Treasury bonds, this is your typical 30-year treasury bond, okay? fixed interest rate for every 6 months, you're paid interest. You can hold it till maturity and get your money back, or you can sell it on the open market. Good luck. And yes, you got to pay taxes on it. The I bonds and the E bonds, you can avoid taxation if you use it for education. But again, you're only paying taxes on interest earned, which right now, again, if you buy them, it's virtually nothing. The interest is added to the account monthly and compounded every 6 months. So that's good. Compound interest is good. This I bond pays interest, a fixed interest rate plus the change in the CPIU. Okay. And you can redeem them with a penalty within 5 years or without a penalty. So you don't have to go sell this on the open market. If you need money, you could just say, hey, give me my money back. And the feds will give it back. But there is a penalty within the first 5 years. The E-bonds, again, very similar setup. You can redeem them, which is great. That's a huge, great part about these I and E bonds is the fact that you don't have to try to sell them on an open market. You can just redeem them, although there's the penalty within the first 5 years. Fixed interest, paid monthly, and they're compounded as well. Here's your interest rates. Let's see, where was the 10-year when I did this? The 10-year when I did this was 0.79%. The 30-year was at 1.58. Your double E bonds, 0.1% right now. Again, I saw somebody that owned them from, I think it was 25 years ago, and they were 6%. Fantastic. It's a fixed interest rate for 30 years. So you buy them when interest rates are really high and coming back down. You don't buy them now. The interest rates are just ridiculous here. I don't know why anybody would use these. All right, so now bank options. CDs, well, yes, I'm sure there's plenty of companies that will pay more than this, but this is actually the national average right now. So the large banks out there won't even sell their CDs. And this is why we're seeing these crazy numbers out there. Yes, there are banks that are still paying a 1% on a 1-year CD, but this is actual national averages right now. It's absurd. But the reality is a lot of the big banks won't even issue CDs right now. They'll sell you something else, and we'll go through them like fixed annuities. The banks are the #1 sellers of them. The thing about CDs is there's no liquidity. You can't touch the money until the maturity term. So that pushes people into shorter terms. Okay, that's a problem. Doesn't compound the interest. You know, you're only earning interest on your original deposit, and that's it, which pushes people to shorter terms. And interest rate is paid and taxed. So when you get paid that interest, you owe taxes on it. So all of these reasons, even if interest rates were higher, you're still pushed into shorter terms with these type of investments. They're not the most consumer friendly out there, but reasonably, we all understand they're safe. They're FDIC insured, and you know, we can sometimes earn enough to keep up with inflation. But in recent history, it has not proved well. Since 2011, it's been a loss every year. So the reality is when you compare what you're earning in a CD and you take away inflation, you're earning virtually nothing, if not losing. So we got to be careful. Money market accounts. Oh, last I saw was a 0.7%. Money market accounts are basically online savings accounts. Okay, we don't need to overcomplicate this. If you're not comfortable online, you're not going to want to do one of these. If you're comfortable investing online, this is really not an investment. This is a bank account with an FDIC insured bank, and it's just earning some interest. Okay, you can move money in and out of there freely. There's no problems using these things. So it's a bank account that's paying more interest than our local big box shops around here, the Wells Fargo's and the Chases and Bank of America's. Okay, nothing wrong with money market accounts, but I can't really call this an investing strategy. Okay, this is what short-term money. If you plan on spending this money within the next few years, then sure, if you don't want to invest it, storing it in a money market account, there's nothing wrong with that. All right, so moving into the insurance world, fixed annuities I alluded to with the banks. Believe it or not, the banks, if you walk into any of the Wells Fargo's, Chase, US Bank, Bank of America, they're all going to sell you a fixed annuity. You might not like the word annuity, but it's typically because you have a misunderstanding of what it is, okay? A fixed annuity is also called a multi-year guarantee annuity. MIGA is the acronym. The reality is this is an insurance company CD. That's all it is. The insurance companies created these to compete with the banks, okay? So it's an insurance company investment with a fixed interest rate and a fixed term. It's the same as a CD. It's not scary. There's no fees. There's no risk. This is just as safe and historically actually safer than your bank CDs. Okay. It's just that insurance companies don't have a place you go into every day. You do your banking all the time, whether you go in there or not. You write checks, you spend money, you use your debit card, you're using the bank stuff all the time. And so they have access to you all the time. But these insurance companies are not in front of your face all the time. And so these insurance companies have had these fixed CDs out there for, for almost 50 years now. These have been around, okay? These are not new investments. It's just people aren't exposed to them. That's all. So understand that there is a difference between these and CDs, but it's because they wanted to hold your money longer. The typical terms are 5, 7, and 10-year terms. So they give you access to your money. They give you 10% access every year with no questions asked, no penalties. Okay. 10% access of the total invested dollars. So if you have $100,000 in there, you could pull out 10,000 with no questions asked. And next year you'll have a fresh new 10% access. They're also compounding your interest and deferring taxes. So if you put 100,000 in and you earn 3%, you have 103, but next year you're earning interest on 103,000, not 100,000 like a CD. So the more time you have it in there, that compound interest grows significantly better than simple interest. And you're typically seeing much higher rates than CDs, and that's obvious right now. These are as of a month or so ago. You can still get 3% on a 5-year. Okay. You get into the 7 and 10 years, it doesn't really make a huge amount of difference. There's a lot more choices in the 3% range at 10 years, but 5 years is typically the sweet spot in these fixed annuities. And the insurance companies created the 2 and 3 year versions just for the banks. Honestly, they never had these until the banks asked them to. Looks like a question popped up. Number 1, are CDs and money markets good if interest rates go high? Well, so, and I'm going to include these fixed annuities as well in that question. The question really is are these fixed interest rates okay if interest rates rise? Well, here's the thing. If you sign up for 5 years to make 3%, you're going to sit there and make 3% for 5 years. If interest rates go to 8% over the next 5 years, then you're going to fall behind. Absolutely, unequivocally, you're falling behind the market, but you're not losing money. That's the big difference. In a bond, you would have lost money. In these, your principal is protected and your earnings are protected. You're just earning less than what you could be earning. So if you really feel that interest rates are going to skyrocket, then you want to sit to the smaller years, the 1 or 2 year terms. So each year you can go shop the market and find the higher interest rate. Okay. So that's an argument for a 1 or 2 year, 1 year CD, 2 year fixed annuity. The reality is a 1 year making 1% or a 2 year making 2.3, I'd take the 2 year every day of the week if that was my only choice. Okay. Are insurance company CDs better? Unequivocally, Yes. Insurance company CDs, these fixed annuities, there is no hesitation or question if these are better than CDs. Unequivocally, the answer is yes, especially right now because it's hard to find CDs that are paying anything. But even in a regular market, these are typically paying 0.5% to a full percent more than what the CDs at the banks are paying. It's just hard to find somebody to do these for you. Anybody with an insurance license can write a fixed annuity, and there's no fees. The insurance person that writes it for you earns a commission from the insurance company, not from your money. But the commission is tiny. The wealth managers want your money in bonds so they can charge you the 1% management fee. Okay. They don't want to put you in this. If they put your money in a 5-year one of these, your money sits there for 5 years and they're not making a penny other than the 2% commission they make up front. They lose money if they sell you one of these. And this is the big problem in our industry is there are biases. Especially in the safe investing world, there's huge biases out there. None of the dinner seminar guys that are selling annuities out there want to sell you one of these because they don't make enough money on these things. Your stockbroker doesn't want to use this because they don't make enough money on these things. But are they better than CDs? Unequivocally, without hesitation, these have always been better than CDs. They were created to be better than CDs. They sat back and looked at what the banks were doing with CDs and said, how do we make it better? And came up with these and offered them. Okay. Oh, somebody's iPad just wrote on there. Let me see if I can erase that. Aha! I don't know who's got the iPad, but somehow you're writing on my screen. Okay, so that's fixed annuities. There is a extension of a fixed annuity called a fixed indexed annuity, okay? Now, some people get exposed to these from the independent financial advisors out there. Raymond James was one of the first big box shops that rolled these out to all of their advisors. Some of the dinner seminars push into these a little bit. But the reality is these have been for the last 5 or so years, these have been a huge replacement for bond portfolios. This is where the advisory world is going to replace bonds. And we're seeing all the big box shops behind the scenes start creating these. They actually went to the IRS and changed rules so they could take management fees out of these. There's a whole change in the industry going on because a lot of us understand and know that bonds are doomed and are a very difficult investment for retirees especially. So we're looking for things that are going to be flexible if inflation hits, that are not going to get hurt if interest rates drop. And that's what these fixed indexed annuities are. It's still the same insurance company investment as a fixed annuity. They still give you access to 10% of the money. It's still tax deferred and compound interest. The difference is instead of a fixed interest rate, they give you an indexed interest rate. Really what this means, and I'll show you an example, is when the stock markets go up, they'll pay you more interest. When the stock markets go down, you make nothing, but you lose nothing. A variable annuity, you would lose if the markets go down. These block you from losing. By regulation, these are not allowed to lose a penny. Not allowed to lose your money at all. No matter what happens to the stock market, no matter what happens to interest rates, your principal and any previous earnings are 100% protected. Okay. There are no fees in these things unless your advisor is charging you a fee to manage the portfolio, including these. And this is something that is new in the industry that is just beginning. For the most part, there are still no fees in these things. Okay. Safety of principal is still guaranteed, and we're seeing the huge replacement in the bond world. This is not that radio and dinner seminar stuff you hear out there that's guaranteeing 7% growth and stuff like that. There's none of that fancy, crazy stuff out there. I call these shiny objects that are distracting you from the truth. We have to be careful about those shiny objects. Okay. So example of a fixed indexed annuity. So these insurance companies look at it this way. they're borrowing money from you and they're investing that money and they're hoping to make more money than they have to pay you. That's the same thing a bank does, by the way. Well, that's the same thing insurance company do. They're in the same business. They use everybody else's money to make money for themselves. That's all they're doing. Okay. So the insurance companies got really smart and they said, well, instead of paying you 3% fixed rate every year, whether the markets are up or down, I'd rather pay you more when the markets are up and pay you nothing when the markets are down. This was kind of an epiphany they had. And so in the 80s, they came out with this concept of a fixed indexed annuity. It's still a fixed annuity, but now they're going to index how much they have to pay you in interest to the stock market. Okay. So in this example, each year on your anniversary, this company would make this calculation. They'd take 50% of the S&P 500, 30% of the Euro Stocks index, 20% of the Hang Seng index. Okay. And they'd add all that up to come up with the weighted performance of the global stock market. So they call this the global stock market went up 22% this year. Okay, this example was from 2013 there, just so we can see the math. Okay, and then in the contract, they're saying, well, I'm going to do this math, and then they're going to pay you 40% of that rise on your anniversary each year. So your anniversary hits, the 22% was how the market did. They pay you the 40%, which is 8.82. They pay that into your account, and your account grows. And it sits there until you say, hey, I want some money, give it to me. It's a bank account. You just reach in and take money out if you need it. As long as it's less than 10% of the account, you're good. Okay. So it's a bank account paying you interest, but restricting your access to 10% of the account. So that way they can keep your money invested and they can keep paying you interest. That's really what goes on here. So if the markets crash, they don't have to pay you a penny. They're happy, and you're happy you didn't lose anything. Okay, you didn't get paid anything, but you didn't lose anything. So when markets rise, you get paid more. When markets fall, you don't get paid anything, but you don't lose. Other companies, and this is real popular out here, I'm not a big fan of caps, but caps are very popular out there. So you can see this is an annual cap, and then they have monthly cap choices. These are not both. This is either this or that. In my example here, 1 year, S&P 500 capped at 6.35. So from anniversary to anniversary, if the market S&P is up 40%, they're only paying you 6.35. If it's up 5, you get paid all 5. Okay. And you can change how you earn interest every year. So 1 year, you might put half your money in the fixed rate and half your money in the Euro stocks. And you get to the end of the year and the Euro stocks is down 20%. So you get paid nothing on half your money. And the other half of your money, you're still getting paid your 3.2%. That's a 1 year interest rate. They pay it to you. And now they ask you, how do you want to earn interest for the upcoming year? And you might say, well, I'm going to put half my money in the S&P and then 10% in the rest. You can split it up however you want. But that flexibility helps a good financial advisor manage the portfolio. Because if we have a year like this, in the beginning of the year when the pandemic was hitting, everybody was panicking, and you could just sit back and earn a fixed rate and let everybody else panic. And then the next year you can index it to the Euro stocks or any other stock index in there. Okay. Some companies use participation rates. So this example is the S&P 500. They're giving you 50% of the rise and none of the loss. When the S&P 500 was down 38% in 2008, you got paid nothing, but you didn't lose anything. When it goes up 26, they had to pay you 13. I'll take getting paid nothing to make 13 the next year. I have no problem with that. Again, you're comparing this to safe investments. These over time have done just as well as bonds, and certainly predictably in the future, they're going to do significantly better than bonds because these are tied to the stock market, not interest rates. And then there's some of these, so I mixed these labels up here that says margin, but this is a participation rate. So we're also seeing these smaller indices, not the S&P 500, but this one's the Dividend Aristocrat, very popular historic portfolio. It's filled with stocks that have had rising dividends for, I think, 20 years. And they're paying you 120% of the rise of that portfolio. Some neat stuff. So there's a lot of different ways to earn interest. And each company will have multiple ways to earn interest, and you can change how you earn. Again, the key to these, no fees, there's no risk to your money, and you do have access to your money. Just because it says the word annuity, it's not there to pay you payments every month. It's there as a bank account that they're paying interest into, and you can reach in and take money out whenever you want. Okay? It's not a big scary beast of an investment. It is simply a better version of a CD, and certainly better than bonds going forward. Okay? So there are ways to use life insurance. I caution people on this world. There's a lot of sales tactics selling cash value life insurance to retirees. Run scared. But please, building your investment, your cash value in a life insurance policy is for young people only. There is age discrimination when it comes to life insurance, period. The older you are, the more costly life insurance is. If you're going to try to build wealth in life insurance, you're either young and healthy and you're going to overfund, meaning continually pay more and more money into this life insurance, or you're utilizing permanent life insurance in order to pass wealth to your heirs. So you're building wealth for your heirs, not for yourself. And that's the key to using this properly. In a part of a plan, it makes sense. Getting sold to anybody that'll buy it is a terrible idea because most people don't utilize this properly. So in my example here, this is a married couple, Jeff age 70, Ann age 65, and they're healthy. Jeff has a big pension, okay? And this pension goes away when he passes away. So he has a $500,000 IRA and he has to start taking required minimum distributions, and they don't want to. Ann's really afraid of what happens if Jeff passes because all the income goes away and she needs the money, okay? So the concern is Ann will have very little income when Jeff passes, and that's when they're going to need their savings. So recommendation, Jeff utilize a safe portion of his required minimum distribution to purchase permanent term life insurance. Okay, it's the lowest cost, no cash accumulation. We're not trying to build cash value in this life insurance. That's where people run into problems, especially retirees. Don't try to build cash value in life insurance when you're already in your 60s or 70s. And then they're going for the highest guaranteed death benefit. Okay, so really all this is he's forced to take money out of his IRA every year. So he takes it out. This is his required minimum distribution. This is how much is left in his IRA. Chooses to pay $15,000 a year. I called it permanent term life. As long as he pays $15,000 a year, the death benefit is available to his heirs. Doesn't matter how old he gets, just pay the 15 grand a year, okay? So he didn't need all of his required distribution. So all he did was reinvest the difference. So an extra 5 grand here, an extra 6 grand, an extra 8 grand, so forth and so on. This is how much money's left in the IRA plus reinvesting all the difference. So when he passes away, his wife will have all this money plus the life insurance policy that pays a tax-free $515,000. So now the wife went from there's a $500,000 IRA that we have to keep pulling from to knowing that when he passes away, she's going to have at least $1 million and half of it's going to be tax-free. That made her happy. And when we look at a return on the investment, this is a guaranteed return on the investment. The only thing that's not guaranteed is when he passes away. And that's the morbid part about this investing strategy is the longer he lives, the less profitable this was. But even if he lives to 90, this was still a profitable investment strategy that was virtually all guaranteed. Okay. You get a long fixed annuity, a 10-year fixed annuity. I use 3.5 here. So this is all just a fixed rate of return in here. And then the return on the investment from the life insurance standpoint is great on top of that. So there are ways to utilize life insurance, but you got to be careful out there. So kind of bringing this all together, we do need to really assess our own needs. In retirement, you have to ask yourself, and this is more the feeling side of it, what makes you feel worse? Okay. Which of these statements make you feel worse? Sell everything, sit in cash, and the market goes up 20%. It's inevitable. Okay. So you decide, I'm done with the stock market, and you pull all your money out and it goes up 20%. And you're like, oh man. Or stay in and lose 20% of your money. Okay. Which one makes you feel worse? So that's going to help you kind of begin that assessment of your own tolerance. Okay. Then we have to get into the reality of your situation. The larger your dependence on your portfolio for income, the less you can expose it to volatility. You have to have a plan for that volatility. You have to be reasonable. Anything that grows safely is going to have restriction to access. We have to be careful about that and have a plan for it. Okay. From a historic perspective, that's the bond portfolio. Again, interest rates going down steadily for the last 40 years, bonds have done really well. Put that into perspective, there's the stock portfolio. Go through the roller coaster of the stock portfolio versus the bonds marching along. Okay. That's 3%. If you just sat back and earned 3% every year. And those are the fixed indexed annuities. Okay. So retirement planning is not just investing your money. Hopefully you saw some of that today. Be honest about where you are and where you want to be. Set goals, educate yourself, develop a strategy, inspect what you expect, and consult with knowledgeable, unbiased advisors. This is tough in the safe investing world. There are way too many advisors out there that have been using bonds all their careers and don't know anything else. That's all they do. It's the only safe investment. And we're transitioning into a world where you just can't do that going forward. So we have to be careful about that. The biases need to get stripped away. Let us know if we can help out in any way. Again, we're kind of used to doing these in person. I always hand out free reports. And if anybody wants a copy of our presentation, all these slides I put up, you just got to let me know. You can email us at contact@sesweb.net or give us a call and just let us know you want a copy of the presentation or the report or anything, and we'll shoot you an email with those in it. The nonprofit requires I give you at least an hour of my time. I don't charge for appointments. This is not a sales appointment. It's literally, you can come in and ask any question you want. We are an essential business. Every time we shut things down here, it's still we're still required to remain open and in the office because we manage wealth, and we don't have a choice. So we're safe, we're masked up, we're cleaning all the time, and we're happy to answer questions and help out if you have specific issues about your situation you want to review. More than happy to chat about it. Especially during the pandemic, I'm not out teaching classes all the time. It gives me a reason to get out of bed and come into the office. So come in and see me anytime you want to. Just let us know if we can help. So those are the best ways to contact us. Our websites, my business website is sesweb.net. So the back end of the email here. The nonprofit website, if you're looking to keep track of our classes, certainly you've got the Scottsdale Library as a resource, but fpfeaz.org is the other way to get a hold of us. All right, I am going to end the recording and open up the questions.